All right, Bruce. So when we hear that the federal government is ready to drop their rates, okay,
Yes.
so is that a direct correlation with us here in the real estate world with mortgages? Does that mean our interest rate is dropping?
No, does not have any impact on interest rates on mortgages. Interest rates on mortgages are tied to the bond market, 10-year and 30-year treasury bonds. They have nothing to do with prime rate or the Fed rate. Now, is there a trickle down effect? Absolutely.
Yes.
However, oftentimes interest rates on mortgages could have an inverse reaction to a drop or a raise in the Fed rate.
Correct.
Now, you have to understand why that is. First of all, you have to understand the relationship between the stock market and the bond market.
Mhm.
So, the stock market or equities are where institutional money and you and I would
Of
go
course.
to make some gains on our investments.
Correct.
But when the market's not stable, it's not a safe place to be. You could lose some money
Uh-huh.
and quickly. So institutional money parks that money in bonds.
Bonds.
Bonds don't move much. They don't make a lot of interest, but
But
they're
it's
a safe
secure.
haven.
Correct. Correct.
Now, when the Fed drops the rate, it's going to stimulate the stock market.
Mhm.
And when the stock market's stimulated, what do you think people are doing? They're investing in the
Into the
stock
stock
market.
market.
So what are they doing with their bonds? They're cashing them in and putting them in equities. And then interest rates on mortgages could go up instead of down.
Right.
Now, could that happen? It happened actually the last 3 times the Fed made Fed cuts. So it can happen, but
Mhm.
it doesn't mean it's going to happen every time.
Right.
We have to be able to understand the correlation between the bond market and inflation,
Yes.
because inflation is the arch enemy. It's kryptonite for bonds. So when you see inflation, you're going to see interest rates go up.
Correct.
So right now, I think that if we look at inflation as a whole, and if inflation is tapered, then you're going to see a reduction in the Fed rate still have a benefit. So I think that in general, we think that rates are going to go down when they cut the Fed rate. We think that rates are going to go up when they increase the Fed rate. They might
Might
not.
not.
There's no way to know.
No.
So there's your answer.
So they're not tied. So just because the Fed drops doesn't mean mortgages are going to drop too.
It
They
does
could,
not
but
mean.
they might not.
That's
So
exactly
thank you
right.
for
It
clarifying that,
really
Bruce.
depends on what happens in the bond market.
Correct.
So at
Correct.
the end of the day, keep your fingers crossed. But typically, we see when the Fed is going to increase the Fed rate, you're going to see rates go up about a month before that.
Right.
When we see the Fed going to decrease the Fed rate, you're going to see interest rates start to decrease a month before that.
Uh-huh.
And provided that the Fed dropped or raised the rate based on what Wall Street predicted, then rates should not change.
Right.
If it's worse or better, they're going to get better or
Uh-huh.
worse.
Uh-huh.
Does that make sense?
Sure does.
There you go.